So welcome to this video. In this video, we are going to solve another NPV problem. So in this NPV problem, the question is calculate the expected NPV of the investment project and comment on its financial acceptability and on the risk relating to variable cost. Okay, so that is about the question here. So we have to calculate an entire NPV for this. So we'll start. VCO is evaluating a planned investment in new product costing 20 million payable at the start of the first year of operation. So it is on the 0th year. The product will be produced for 4 years, at the end of which production will cease. So the project is only for 4 years. The investment project will have a terminal value of 0. So scrap value is 0. Financial information relating to the investment is as follows. Years, they have given the sales units per year. They have given us selling price per unit, and they've given us fixed cost per year. Okay, these selling price have not yet been adjusted for selling price inflation, which is expected to be 3.5%. So we have to inflate this selling price. The annual fixed costs are given above in nominal terms, so these have already been inflated, so we don't need to inflate the fixed cost. Variable cost per unit depends on whether competition is maintained between suppliers of key components. The purchasing department has made the following forecast. So they're not like very sure about what is the variable cost per unit. So they have given us probability. So multiply the probability and the variable cost for strong, moderate, and weak. We'll get an weighted average variable cost. So this variable cost in this forecast are before taking account of variable cost inflation of 4%. So we have to add inflation of 4% to this variable costs. So they also say VCO can claim tax allowable depreciation on a 25% per year, reducing balance basis. So it's a written down value basis on the full investment cost of 20 million, and the company pays a corporation tax of 28% per year in 1 year in arrear. So the tax is going to be 1 year in arrear. So the number of years we have to calculate is for 1 to 5. It is planned to finance the investment project with an issue of 8% loan notes redeemable in 10 years time. VXN has a nominal after-tax weighted average cost of capital of 10% and a real weighted average cost of capital of 7% and cost of equity of 11%. So again, he has given you all the information here. So we'll start. So we are going to do this question for requirement B. So we'll start with the particulars. So particulars, we'll solve this question in terms of thousands so that it's quite easy. And we'll have a working note so that if there's any working note that we have using, we can refer it back. And we will also start with the years. So it's 0th year here, 1st year, 2nd year, 3rd year, 4th year, and 5th year. We'll start from the working notes. So we'll have the first working note. So what is the first working note that we'll have? So first we'll start with the sales number. So we'll have inflated sales. So that's what we are going to work first, and we'll take the years as they are and we'll just copy it here. So we'll start with the sales volume, which is the units. Then we'll multiply it with selling price, but selling price is before inflation. We don't want before inflation. What we want is the inflated number. So we'll have the inflation, so that we will end up with selling price after inflation. Okay, we'll get this number. When we multiply the selling price after inflation into units, we'll get the sales Okay, we'll get the sales. So that is what we are going to do. So we'll start with the units. So units is going to be 440 and 550 for the second year. Third year it's going to be 720. Fourth year it's going to be 400. So we'll work out in terms of thousands. So we'll have the selling price. So the selling price are different numbers. So they're not the same number. It's 26.5. It's 28.5. Then we have 30. Then we have 26. If you take the inflation, we'll take the 0th year. Today, the value is 1. At the end of 1 year, it would have inflated or it would have gone up. So what would be the inflated value? The inflated value will be this number plus open bracket again the same number into the inflation is 3.5%. So it's into 3.5%. Now close the bracket and enter. You get a number here. So you copy this number and you paste it across. The number should increase like this. It should be 1.035. Then it should, like compoundingly, it should increase. So because it is a compounding formula only, so that we have done. So the next step is to multiply the selling price before inflation and the inflation rate. So this is the selling price after inflation. So we got for all the years. So for sales, we have to multiply this value, selling price per unit after inflation, with the number of units. So if we do that, we'll get our answer. I think we have not done the open bracket. We'll get an answer. We got it. So we'll do it for the other years. So we got our numbers. So we'll take this number, okay, these numbers, and we'll paste it here. In exam, if you don't have this special paste function, then you have to type each of these numbers individually. As in Excel, we have all the formulas easily. We can quickly get it. But in exam, if you don't have this function, you have to type each of these individual numbers. Okay. So working note number 1 is done. So we'll move on to the next working note, which is variable cost. So we'll have it here. So variable cost is of two elements. First, we have to get the weighted average variable cost. Okay. So we will have it as weighted average space variable cost. So how do we work it out? It's very simple. We'll compute it in a single line. So you have 0.45 into 10.8, right? Then you add the next variable, so which is 0.35 into 12, and then you will leave a space and you then add the last element, which is 20%, which represents 0.2 into 14.7. Close the bracket. Okay, we have an open bracket, so we'll have a close bracket here. We'll enter. We got answer as 12. So that is the right answer. We got it is 12 per unit. Okay, so weighted average variable cost per unit is 12 per unit. So rather than working out in a table, this is a much easier method. If you're not able to get this method, then you have to work out in terms of weighted average table, but that takes a longer time. Okay, so what we'll do is we'll move on to finding out the inflated variable cost. So we can, to find out the inflated variable cost, we'll take these numbers as they are and we'll try to work it out. We'll just change things. Okay, so this is going to be working note number 3, and what we are going to do is variable inflated variable cost. So we'll start. So inflated variable cost unit is the same. We don't want selling price before variable inflation, we want variable cost before inflation. So that is going to be a same number, which is 12. So we can have it as across as 12, and inflation is going to be how much? Inflation is going to be 4%. So here if you see inflation, variable cost inflation is 4%. So go to this formula and edit it as 4%. So your answer is changed only for the first year. Do the same for the balance 3 years. You got the number. So what you got here is the variable cost after inflation. So here you will get the total variable cost. You get the total variable cost. Okay, so check whether this is like multiplied properly. Yes, it's units into variable cost after inflation. So that is a right answer. So you can take this answer and you can go to the table here and you can paste it. You can take this answer and you can paste it. So Alt E, S and V will give us the answer. But again, this step might not work in your exam. So ensure that whether this step is available, whether these formulas are available. So total variable cost is working note number 3. The next step is to find out the fixed cost because it's given. So fixed cost, they have given it here and they say that it has been adjusted. Okay, the annual fixed costs are in nominal terms, so you can directly take that number and you can work it out. But there's a small problem here. If you take the variable cost, all these numbers are negative numbers, so ensure that you are converting them into negative so that when you work it out, it's quite easy. So we got it as a negative number. Fixed cost again should be a negative number. So we'll work out in thousands. So it's going to be 1100, 1121. It's going to be 1155, and this is going to be 1200. So we got our to give us profit before tax. So we got the answer for the first year. So do it for the other years and you will get your total answer. This is the profit before tax. So now we have to find out the tax. The tax is at they have given the taxes at 28% and it is in 1 year in arrear. So first we'll find out the tax. So the tax is this number into 28%, but the 28% is a negative 28%. So you got a number, and this has to be done for the next 4 years. Okay, so that's why we have the 5th year, because it's for the tax arrear. Now we have something called as a tax allowable depreciation. So for tax allowable depreciation, we have to work out the sum. So we'll go to another working note. So we'll have it as 4th working note, tax allowable depreciation. Okay, so to compute tax allowable depreciation, there are like many ways. So we'll choose a table approach. So we'll start with particulars and we'll have years. So years we'll start from first, second. So we have the years. So we'll have the opening value. We'll have depreciation at some rate would have been given. So depreciation is at 25%. So it's 25%. And then we have the closing value. Okay, and after getting the closing value, we have to get the tax allowable depreciation at 28%. Okay, at 28%. So we, this is how that we have set the table. So we'll start. The value of the asset is 20 million. So we are working the sum in terms of thousands. So we'll first find out what would be the value of the asset. So the value of the asset is 20 million. 20 million, but we are working it in terms of thousands. So this will be the opening value of the asset. So depreciation would be the asset value into 25%, and that is going to be negative 25%. So it is negative 0.25. So you got the depreciation, and closing value is you add this number plus you add the depreciation number. This is going to be a closing value. So what you do is you reference this cell now. The next year opening value, second year opening value will be the first year closing value. So you can just refer that, and depreciation would be the same depreciation. So you can put that also. The closing value is also going to be the same computation. So you can take that also. So what you do is you take this and you spread it for the 4 years. So we have done it for all the years, but that's a single additional element. First, find out what is the scrap value. The investment project will have a terminal value of 0. That is, in the 4th year end, there is not going to be any scrap value. So the scrap value is 0. Okay. So don't have the formula for calculating the depreciation. That's not required. But what happens is the difference between the opening value and the scrap value is the loss. It is a loss of the asset. So loss can also be in for loss of asset value is depreciation. Okay. So what we can do is this number, okay, this number that is there is a loss value. So what we'll do is we'll take the same number 8437.5 is a loss value. So it is a negative number because the asset was in opening 8437, but in close it was 0. So the entire amount is a depreciation. So we have to calculate the tax depreciation now. The tax benefit that we get is on the 5000. Okay, that is into the rate. So the rate is a 28%, but as it is a tax, we will take it as a minus 28%. So we'll compute. So that comes to a positive number. Is it right to take it as a positive number? The answer should be a positive number because the tax allowable depreciation is a inflow for the company. So we have to compute it for 4 years and we got the number. If you work out now, you might see here that in the 5th year, okay, the tax is occurring for the 2nd year, 3rd year and 4th year and the 5th year. So take these numbers, okay, take these numbers and you can go to your table. So in the table, you can work it out like this. So you can take it off this. This one was working note number 4, and we have the depreciation, the tax allowable depreciation. All these numbers have to occur for the 2nd to the 5th year, and they should be a positive number. So we have got all the numbers here, and now we have to find out the profit after tax. So we'll quickly work out that, and that is nothing but a sum formula. So we'll copy a sum formula which is already there, except for we'll change the range. So the range will be this number, tax allowable depreciation, tax and the profit before tax. We'll take all these 3 numbers and we'll close. So we'll copy it and we'll paste. So anywhere you take, it should take 3 numbers into account. At least even a empty box is there, but that doesn't matter. we have to take all the numbers. So we got our profit after tax. So if we go through, we have finished sales, selling price, fixed cost, variable cost, okay, taxable depreciation, tax, and we have only like two more elements. The one element is the investment. The investment is 20 million. So we'll take that as a our consideration. So the investment is a cost. So investment cost is a negative cash flow, the cash outflow. So that comes to 20,000. That's what we have calculated in the tax allowable depreciation here. So that is the same 20,000. So here now there's no scrap value or working capital. So what we can do is we can do the cash flow. So the cash flow is this number plus this number put together is our cash flow. So our cash flow is these numbers. So we got them. Now we have to get our discount factor. Discount factor for 0th year it's 1%. The next year it's going to be 1 divided by 1 point what number. So to confuse us, they have given us as a paragraph here. It is planned to finance the investment project with an issue of 8% loan notes. This is not required. And VCO has a nominal after tax weighted average cost of capital of 10%. That is what we want, because nominal is inflated. After tax, yes, we have done the sum up to after tax. A real after tax weighted average cost of capital is not required because we have inflated the numbers, so this is useless. Cost of equity again is useless. Okay, this paragraph is only to confuse us. You just have to take this 10% and solve. So the formula would be equal to the power of divided by 1.10. So we'll get the answer. Now as it is reference, it would give us the discount factor. So we'll push the other numbers down. So we have done a lot of working. We'll push all those working down so that they are neat. So we can find out the discounted cash flow now. Very simple. Cash flow into the discount factor. We got the number. Do it for all the years. We got all the numbers. And finally, when we add all of them, we'll get the NPV. So NPV is a sum of these numbers. So close the bracket and find the answer. The answer comes to 2847.6. So always have your suggestion. So suggestion is very important. The suggestion is, as NPV is positive, accept the project. So that's about the accepting it. So wherever that needs to be highlight, we do it. So we can highlight the working notes headings. Okay, the loss heading also you can highlight it so that it's a very important point. So let's see whether we have left out anything else. Calculate the expected NPV of the investment project and comment on its financial acceptability. These we have done. And on the risk relating to the variable cost. So and on the risk relating to variable cost, I think it is a sensitivity, but we can say that rather than doing a sensitivity, we can just explain. So in terms of variable cost risk, okay, so we can say that normally we have taken the variable cost at 12 per unit. So this was our 12 per unit, but if the number is going to change to 10.8 or 14.7, that is going to be very dangerous. So you can say, as variable cost is an weighted average, the cost can move either way to 10.8 or 14.7. Hence a full sensitivity sensi- sensitivity analysis needs to be performed to know the impact of the change in variable cost. Okay, so that is what we require. So variable cost risk, it is 12 is a probable number or weighted average number. It can either move to 10.8 or to 14.7. So what happens is, if it moves either way, it will either help us to make more inflow or a negative inflow also. So we have to work out a sensitivity analysis to find out like how it works. So as this question is not asking us a sensitivity analysis here, we don't need to do it. Okay, so that is how you can answer it, and that's about this question. Thank you very much.